Good morning, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. I'm your host, Cody Laughlin, and joining me as always is my co-host, Mr. Brian Alfaro. And I'm really excited for today's guest. We got a powerhouse with us today. So, Brian, tell us who that is.
Absolutely. Today, we'd like to welcome Alex Breshears to the show. Alex is a private money lender, a Reg A fund investor, relations manager, a multifamily underwriter, educator, limited partner in multifamily syndications, and community builder who partners with active and passive real estate investors, syndicators, and military spouses to grow their financial independence, knowledge, and professional network. Alex started a private lending company, Infinite Road Investments, in April of 2020. I'm going to be interested in hearing about that, starting a business during COVID, funding first lien and second lien positions for residential property in Hampton Roads, Virginia area. She also started an educational Facebook group called Private Lending Lessons, which offers weekly educational lessons, daily posts for discussions, and opportunity to network with other investors about private lending in various projects that may need funding. She also works with a team at Mission First Capital, a Reg A fund that helps active duty and veteran service members invest in real estate to improve their long-term wealth. At Mission First Capital, she works in organizational management, investor relations, and underwriting for property acquisitions for asset purchases. Alex is also passionate about financial education and independence for female investors. She is currently a chemistry professor teaching for a 4-year school online and leading biweekly educational series about real estate investing in her Facebook group. She's an LP for 16 units in Newport News, Virginia, in addition to owning and co-hosting short-term rentals. Alex, welcome to the show.
Thank you very much for having me.
Hey, it's a pleasure, Alex, and really excited to have you on. I know we connected several weeks ago through a mutual friend, and really excited to learn more about you and your background. So tell us a little bit more about your story.
Absolutely. So as my bio, so eloquently put, I am a military spouse. My spouse has been an active duty Navy service member for the last 20 years. So his golden handcuffs have been broken as of July of last year. So he's not retiring anytime soon. I think a lot of people assume once you hit that 20 years, there's some like magic switch that's flipped and you're done. So I would probably be a military spouse for at least another 5 to 8 years. And that's created a very interesting lifestyle that I feel a lot of just civilians or people who don't have any affiliation with the military don't really quite get. So just for example, I've moved 19 times in 20 years. So I'm currently sitting in my 19th address in 20 years. And that sounds like, okay, what does that have to do with real estate? If you think about when we talked about COVID, a lot of things got moved online. We forced technology to kind of deal with our, remote environment. Well, 20 years ago, that wasn't a thing. There wasn't an ability to get on Google Street Maps and kind of walk down a street to evaluate a property. So the idea of investing remotely in real estate, 20 years ago was still a very new, maybe budding idea, wasn't very broad-based. So when I first started investing in real estate, it was very much, kind of a traditional path that I feel like most people that do real estate investing do is, fix and flip and buy and hold. That's kind of your two options presented. You're going through door A or door B. But I had a weird kind of trajectory in that, going to a local RIA meetings, just talking to people. And I got talking to someone who was a hard money loan broker. And he's like, "Oh, you're a science major. You must be good with math and numbers." And I'm like, "Yeah, pretty good. I'm in Calc 3 right now, so I could do it." And he's like, "Well," he was explaining kind of what hard money loan brokers do. And he was looking for someone to help in his office and do all this. And I was like, he said the magic words every college student loves, you can work your own hours and if it's flexible and, you don't have to be in an office. And I'm like, sold, let's do this. So I actually kind of got an introduction into lending from the real estate investing perspective, because back then I was literally driving to the properties, with a 1003 in hand to have the borrowers fill out the application. I'm walking the property with the borrowers. So I was getting a crash course in real estate investing education, and I was being paid to do it. But on the flip side of that, I was also helping in the office. So I was the person cutting the checks, at sometimes being the actual courier, taking them over to the title company and processing the payments when they came in. And the kind of prevailing theme I always saw was, no matter what happened, the mortgage had to be paid. The tenants moved in and stopped paying, mortgage still has to be paid. the contractor's 3 weeks behind or 3 months behind, the mortgage still had to be paid. And I was processing these mortgage payments, coming in anywhere between $700 and $2,700. And then I'm out in the field, obviously talking to these active investors, and they're kind of keeping their fingers crossed, that nothing breaks and they're going to get their $150 a door. And it really opened my eyes to being on the other side of the table and what kind of power there could be on the lending side. And we did literally 2 fix and flips. We had 2 rentals. That was almost 20 years ago, and we will never go back. So it's just not our thing. It's not a bad way to invest. It's just, I don't think a lot of people, when they think about investing in real estate, they don't take the time to really think about what styles of investing suit their goals, their capital, maybe their skill set, their time. And fix and flip and buy and hold didn't necessarily fit our skill set and our time, because we were moving 3 months, 6 months, 12 months. The longest we'd ever been anywhere was 22 months. And so doing a buy and hold or fix and flip investor, that's extremely challenging. So it didn't fit our lifestyle in that particular case. Whereas doing private lending or working in a fund, as long as I have electricity and internet, I could do that anywhere.
Awesome. That's a great story, Alex. I think what you just said is something that you don't hear a lot that's very valuable to our listeners. Real estate is not a one size fits all type of asset class investment. There's so many ways to be an active or passive real estate investor. And I like to tell people there really is no right or wrong. If you like self-storage or industrial or triple net or multifamily or single family, or you're a hard money lender, or you like REITs, there's no right or wrong. It's just figuring out what investing strategy best fits your lifestyle, your investing thesis, the type of returns you need, and then just staying focused, not getting shiny object syndrome. I know Cody and I have talked about that in the past, but there really is no right and wrong. You just really got to find something that matches your personality. That's why I went from single family over to multifamily. I like the scalability and the business of it. But again, there's no right or wrong. So I think that's an important message. And I think sometimes the best way to learn is kind of trial and error, right? Maybe you do a couple of fix and flips and it doesn't go well, or maybe you buy a couple of rentals and you don't like being a landlord and you decide to go passive, right? So I think that's an important lesson. Thank you for sharing that.
Yeah, absolutely. I run into it frequently. And one of the reasons I started the Private Lending Lessons Facebook group is I wanted to bring the option of private lending to people as more of one of that front door options. So private lending, fix and flip, buy and hold. So passive investors have more of the spotlight earlier on in the conversation.
Yeah, that's powerful. And I like that. And, to Brian's point, I think what people don't understand is this is a labor intensive business. I think people hear the allure of real estate investing and they're like, passive income, and I'm gonna be sitting on my couch and
mailbox money, get that
mailbox money. And it doesn't quite work that way. So, but what's interesting is we actually have not had, not to my knowledge, I'm trying to go back and think, we have not had a private money lender on the show. So this is really interesting to get somebody from your seat, your perspective, and kind of talk about that a little bit more. So, when it comes to being a private money lender, for those who may be interested or wanting to learn more about it, what are some things that they need to know when considering that as a way to become an investor?
I would first really drill into exactly what you want to lend on, what you're comfortable lending on. So if you want to work on just fix and flips, do you want to do, buy and hold, just literally anything? Just really drill into, for example, when I talk to people, part of my elevator pitch of being a private lender is I tell them I only fund fix and flips in Hampton Roads that are, within 6 out of 10 or better for all 3 schools, all 3 elementary, middle, and high school. They have to be within 10% of the square footage of the neighborhood. So I don't want something that's the biggest house, and I don't want something that's the smallest house. And they also have to be within about 10% of the average household price for that zip code. So again, I don't want the beautiful neighborhood that's surrounded by not so great community. So I really want that middle of the road, something that everybody wants. And people often ask, if you drill in that closely, like this is exactly what I want, this is the only thing I'm going to fund, that you're not going to have borrowers. And I'm telling you, I have more borrowers than I have capital, and I have more requests for funding coming in now, more so now than ever, because COVID, you were talking about opening a business during COVID, what that looks like. it's exploded. It actually started because of COVID back in March of last year. That's kind of when the world shut down here in Virginia, and hard money lenders shut their doors. They just literally, their warehouse lines of credit, their hedge funds, whatever, just stopped and said, we need to take a beat. We're not sure what's going on in the economy. And again, going back to that networking component, I knew another active duty service member in the area, and he was mentioning we were in a Zoom room, when Zoom was still a very new concept to a lot of people. And we were in a Zoom room together, and he mentioned he's potentially going to be losing out on this deal because the hard money lender just pulled funding, shut their doors about a week before he's supposed to close. And I was like, well, tell me about the deal. And it turned out to literally be the type of project I would want to lend on. He was the type of borrower I'd want to work with. And I was like, hey, we exchanged information. We talked offline, out of this Zoom breakout room. And I was like, you know what, we can make a go of this. If you can give me 2 weeks, I'll figure it out. One of those things, just say yes and figure it out later. And so I got attorneys involved. They drew up the LLC paperwork. We did some research into the lending requirements, for the state of Virginia. And then 2 weeks later, we had funded our first loan and we were off to the races. I mean, it really, I don't want to oversimplify it, but I also want to make it sound like it's fully attainable, because it is. I mean, it's just a matter of just putting one little step, one little step, one little step. And next thing you know, 10 steps later, you're in a completely different place.
Yeah, that's a consistent message that we talk about all the time, is people don't understand, is like, you got to get out of that comfort zone. You got to take the step of faith, got to put yourself out there. And sometimes it does. It takes a little bit of discomfort, but listen, you just do, and you figure it out as you go. And I think the key is just surrounding yourself with the right people, and having the right motivation, and you're off to the races, like you said. And Alex, before we get too far in this, I wanted to make sure I reference and send the best regards to both you and your husband as a military couple. Thank you guys both for your service and to the country. I want to make sure to highlight that. But getting back into the private lending world, a lot of people may be hearing that. And look, Brian, I think we were just talking about this yesterday on another show, is there's something to be said about being the bank, right? I mean, it's a good seat to be in when you're in that first lien position, but there's some things that you got to know in order to step in this world as a private lender, right? You as a private lender, you have to make sure that you protect yourself from some circumstances. Talk to us a little bit about what are some of the layers that you need to do to protect yourself before getting into some of these transactions?
I would say, first off, I would personally go and create some sort of business entity. So it's not you as an individual loaning money to another individual. There's a limit to what you can charge as far as interest rates, fees, what your repercussions are for collecting those amounts. And those are dictated by something called the usury laws. And every state, and sometimes each municipality, can have additional usury laws above the state. So that's something you want to keep in mind, because there's those different buckets within the usury law. So for example, an LLC lending money to another LLC, they would consider something like a commercial loan. Obviously, it's going to be on residential property, but they would consider it a commercial loan. So in that regard, there's not as many, consumer protection, measures put into place. So the interest rates can be higher, the fees that can be charged can be higher, versus just, Bob Smith lending money to, Joe Smith. That's going to be two individuals. So that's a completely different set of usury laws. Also, lending money for properties that are non-owner occupied has a completely different set of rules and guidelines than property that's going to be owner occupied. So for example, I and most private lenders that I personally know will only lend money on non-owner occupied property, because there's so much regulation and so much that needs to be taken care of and made in advance, and the licensing for owner occupied property. So a lot of times that's very upfront, that we are only lending on investment property because of those reasons. So that would be something else I would let people know. That's why I said drill down really deep into what you're willing to lend on, and then that will give you a guiding principle as to, can you do that in the first lien position in your market? If you can't, for the amount of capital you have to deploy, what other markets in the country could you potentially invest in? What are their state laws? So it really all starts with, what are you comfortable lending on? What would you like to lend on? In what position, kind of risk tolerance? Are you only first lien position? Are you comfortable doing some gap funding? Those types of things. So if you can really drill into what you're comfortable doing, that's really going to be a guiding principle for all the other steps after that.
Yeah, and I think Alex too, one thing for people to consider who may be interested in going this direction is finding an expert like yourself, right? It's not necessarily about starting your own company to be a private lender. There are plenty of private lenders or hard money companies that are looking for investors to fund their projects, and they're sort of playing that middleman. And obviously, everybody wants to win in those projects. You want to get your expected returns. They want to take their fees and get their expected returns. But it's a I hate to say an easier way, but it's a way to align interest with somebody who maybe has a track record lending, who knows how to do due diligence, because that's probably the hardest part. Maybe you've got 100K in a bank and you want to loan it out, but like, what does a good deal even look like if you have no real estate background? Using that middle person, company, like a person like you who has a company or another hard money lender, that's a great way to get started, don't you? Would you think?
I would say it really has to matter with what their goals are. If they just want to place $100,000 and kind of set it and forget it, and they want to be purely on the debt side of the equation, then that's absolutely perfectly fine having something like a broker. And there's various levels of involvement with each broker. Some brokers, will just say, okay, give us your $100,000 and we'll place it. Other brokers will actually email you out like a little packet for a borrower proposal, and you actually get to kind of read through the borrower's profile, the property underwriting, all of that. You can say yay or nay. You want to, make the decision on that. So it really varies anywhere from, here, just place my capital and give me my 8% return, all the way to you actually get to be the person looking for borrowers, underwriting the whole thing. So it can be as active or as passive as you want it to be.
Yeah. Brian, I want to kind of piggyback off what you were just mentioning a second ago, because Alex, over the past couple of episodes that we recorded, we've had some different niches as far as our guests go. We've had somebody talking about short-term rentals. We've had the industrial triple net space, and now you as a private money lender. And, obviously we're a multifamily show, we're all things apartment syndication. But what I love about this conversation is the things that you've outlined are fundamentals that apply to just real estate in general, identifying, who you are as an investor, what your investor appetite is, that risk tolerance that you mentioned, finding that niche, and getting educated, and then just building a good team around you. So the message is consistent no matter what vehicle you're taking. And I just, want to highlight that and make sure that people are catching on to this. And, going back to your point, the reason I asked about, so like protecting yourself as a private money lender, is because I know I've heard many of these stories where people get interested in being a private money lender and they don't put the right things in place to protect themselves and their position. And then you hear the horror story of like, oh, I lent this guy 150 grand, 200 grand, and then they disappeared. You know what I mean? And so I think people need to just, make sure that you're putting the right things in place to make sure those things don't happen.
Yeah. And to be clear, what I call private money lending is where you have secured interest in a property, whether you're in the first lien position or second lien position, because I get contacted by people frequently that are like, oh, my cousin's best friend wants to start being a real estate investor and I want to give him $30,000 to start his business. That's not private money lending. And that's where I hear personally a lot of the horror stories is, oh, I've done some private lending, and I gave an investor $30,000 to renovate this and he went off to Vegas. And like, okay, well, that's great, but you didn't do private money lending, in a secured fashion. You did it. You just basically did a business loan, or essentially a personal loan is what I see a lot of it. Like, oh, they signed a promissory note, and well, did you do any sort of background on them? Is it secured against any sort of property? So I think that's the other kind of differentiation. I want to let people know that it is a secured, lien instrument. You have a deed of trust or a mortgage recorded at whatever, public municipality the property is in. So it's completely different than what I think a lot of people envision private money lending to be. I mean, it can be that if you want to just lend money to an investor and say, do with it what you will, I trust you, that's fine. But when I'm talking about private money lending, I'm talking about it being secured against collateral. So in your case, in your example, if they did lend out $150,000, $200,000 on a piece of property, and the borrower disappears, well, then you can start foreclosure proceedings, default, whatever that process looks like for your state in your particular deal. So you could potentially recoup some of that money or all of that money back versus just giving them $100,000 and say, do what you will. I just want my 8% mailbox money, for the year. Just, here's the address.
Yeah, that's such an important takeaway. Again, people have to understand you are you are the bank essentially. And if you think about going into a bank and you go sign for a loan, they don't just write you a check and say, okay, here you go. There's a process and steps and documents and stuff. You got to approach this business that way, I would, imagine. So, kind of pivoting a little bit, Alex, I'm going to be honest, and I hope that any other private lenders out there don't get offended, but in the commercial space in particular, I know that you're focused on your short-term rentals, but every now and then you'll see the occasional private money lender in the commercial space. And I'll be honest, I'm a little skeptical because it's just the two asset types are different. Are you seeing interest? Are you seeing a pool of private money lenders in the commercial space? And is it a different world from residential to commercial for you guys?
I haven't necessarily seen it directly in the commercial space as far as like, I'm going to give you, 70% loan to value on your property. What I am seeing from private lenders in the commercial space is doing earnest money deposit lending. So if an operator needs, 100,000 or 400,000 to get the deal up and running, doing the loan origination fees and the due diligence costs and setting up the SEC attorney, syndication process can be costly, all those kind of upfront costs. If the operators are unwilling or unable to kind of, while they're putting their GP team together, that main operator might really need to lock down the deal and put down a $200,000 earnest money deposit as soon as the purchase agreement is accepted. I see private lenders moving into that space more and more, just being able to offer earnest money loan deposit or earnest money deposit loans. Either in exchange for potentially, they'll keep that money involved and be an LP. Depending on the amount, they might keep that money involved and have part of the GP part of the process. Or sometimes it's just straight, debt deal. Once you get the deal closed and you get your acquisition fees or whatever, I get paid back whatever the agreed upon amount is for that particular loan. So I've seen kind of all three of those. That's mostly what I see in the multifamily commercial space when it comes to private lending.
Hey, that's interesting. I appreciate you alluding to that because I was always kind of figuring out, look, some of these transactions we're looking at, tens of millions of dollars. And it's like, it's hard to imagine there's somebody just sitting there with $10 million and saying, yeah, I'll give you that 70% loan to value and whatnot. But that makes complete sense. And I think that should be inspiring for some of the listeners out there that are looking to source alternative capital. If they're not looking to raise capital from others, that's good to know. So
yeah, absolutely.
Well, we alluded to you in your bio. You're somebody that apparently hates education. You're a teacher. You got this Facebook group, and we joke, but one of the things that we talk about, one of the reasons why we have our podcast show is to be able to give back through education, right? Provide that value through education, and you're doing exactly that. Talk to us a little bit about your Facebook group and really what was the inspiration behind pulling the group together? I know you had an interesting story when we talked offline about it.
Yeah, absolutely. So during COVID, the world shut down. My world got very small because as an extrovert stuck inside, married to an introvert, if I got 100 words out of him at one time, like that's a busy day for him. He's chatty. So, I had to rely on community. I'm a very big community-based person. And I was like, okay, they have groups for landlords. They have groups for, buy and hold, the BRRRR and everything else. And then when I went out looking for community with other private lenders, I'm like, there has to be other people doing this, because Bigger Pockets, to their credit, they do a lot of great education. But, anytime private lending was ever mentioned in Bigger Pockets was go find a private lender to fund all your deals. And I feel like that left that side of the table going, all right, now what? And there wasn't a lot of education for active investors either on how to partner with a private lender. Still to this day, I have active investors that think private lending is like a 20% down payment assistance program. And I'm like, no, it's not how this works at all. So when I went looking for community, every Facebook group I joined that had private lending, private money, hard money, nothing was education based. It was all basically a place for scams and spam is really what it was. There was no conversation on how the process worked. How could I mitigate my risk in this situation? Nothing about how to do underwriting, how to even collect documents. So I was like, all right, being a military spouse, I don't live anywhere long enough. So if I can't kind of find a tribe pretty readily, I'm just going to build one. So somebody said, start a Facebook group. And I did. And then about a week later, I had 100 people. I was like, oh, crap, now I got to do something with this. And then the group's about 7-8 months old now, and there's 2,300 people in it. And it just became this life of its own, because there was that need for education about how to do it. A lot, I've been approached by a lot of people, like, I don't know how to do this. Like, it sounds great. It's something I want to do, but there are a couple books out on Amazon about it. I own all of them. I've read all of them, and they read more like a textbook than they do the application. And I think that's part of the education that's really missing, is the application of how to do it. Like, it's great, what LTV means, but do you know what, the difference in risk would be between doing a loan that's 50% LTV and one that's 75% LTV? That really just kind of comes with the application and talking to other people who have done it. And that's what the group offers. That's literally what the group was created for, is to bring private lenders together. And then we kind of opened it up. As I started talking to more active investors, I realized how little education they had about what private money was, that they didn't know the process of attracting private money to their deals. They didn't know the process of working with a private money lender, what usual terms were. I mean, still to this day, I probably get 5 to 10 messages, Facebook, LinkedIn, all this. What's your rates? And I'm like, it doesn't work like that. It's not private money and hard money, although the terms are used interchangeably quite frequently. They are very different. And, I don't work off a rates term sheet. I want to know you as a person. I want to know you as a borrower. I want to know your track record. And that's going to kind of dictate the terms. It's a lot more negotiating when you're working with a private lender. It's not checking boxes, that you have a credit score of 620, it's a 65% LTV, and, all of these other things. It's really very much more relationship-based model, which is very similar to multifamily, which is why the group also focuses on investing passively, through things like syndication. We often have operators come on and talk about, whatever aspect of syndication they might be working with, their unique story, their unique take on a deal. And teaching that LP side of syndication is also happening in the group, because those two things in my mind are very similar. You're still doing due diligence on essentially a borrower. You're still doing due diligence on a property. You're still learning, about that market. So I think the two things have very overlapping skill sets. So once you learn how to do it for private lending, it's just a matter of kind of translating that skill set over to multifamily.
Yeah, that's great. And the fact that you've gained so much momentum in your group, and I laugh because I know when we first talked about it, the first time we met, is you said it happened by accident. And all of a sudden you were like, oh crap, I've got something. But the cool thing about that is, people are looking for that education. They're looking for that value add, especially when, like you said, there's a gap in the market. And so when you're filling that void and you're providing that education, that's what's going to continue to gain that momentum. And so, big kudos to you, because that's really, really important. And I think that's a mistake that as entrepreneurs who are trying to build credibility, and as they're trying to build a business and build a brand, if you will, when they go out, they think that, I just put out one video clip and, I'm going to be an overnight success. And it doesn't work like that. You have to really just provide that good concrete value that people are really going to be drawn to. And so that's really exciting.
Yeah, I mean, the group has been absolutely life-changing for me. I've met business partners through the group. I've talked to people from literally all over the world that are investing here in the United States. I mean, it's just been absolutely amazing. I've talked to people who have met business partners in the group. I've talked to people who have met, private lenders in the group, private lenders who have met borrowers in the group, private lenders, like to Brian's credit, who have met brokers that they're placing capital with. So they're not necessarily doing all the heavy lifting as far as the underwriting, the due diligence. So, I mean, it's just been a great, just literally an online community in the truest sense of just education, and having that abundance mindset that me teaching other people how to do private lending is not taking business away from me as a private lender, because I'm teaching other families how to be more prosperous. And even if they're in my own community and they might, from a business perspective, be a direct competitor, they are being more prosperous, and they are in my community being more prosperous, which makes my community as a whole more prosperous. So it's really coming from that abundance mindset of being able to share something with someone that says, this is free knowledge. I happen to know some of it. Maybe in the future, there's some knowledge that you will know that I don't know that we can share in the future. So it's taking a long-term approach with an abundance mindset.
Yeah. And that's one thing we always make reference to. We love about this community, man. When you have that abundance mindset, look, I mean, there's so much out there for all of us to participate in. We don't have to go out there and be greedy, and nor do you want to try to ride the ship solo. It's a lonely ride if you try to. So, definitely good to have those relationships. Alex, I want to kind of talk a little bit, if we can, again, as multifamily investors ourselves, as fellow syndicators. I want to kind of talk a little bit about, your conversations within the group or educational piece more towards the LP side, the passive invested side for commercial real estate. And I know you mentioned you have other operators come into the group and maybe present. Can you give us a little bit more insight as to, some of the content or education behind educating your private money group on the power of being a limited partner?
Absolutely. So, for example, just this past Tuesday, we had a commercial lender come on that also does syndication himself. And he talked about the lending implications for the LP investor. So, for example, when you go to watch a lot of these pitch decks for these deals, they'll tell you about the market, they'll tell you about the rent bump, they'll talk about how conservatively the deal is underwritten. But in my experience, very few of those pitch decks really dive into the lending. They'll just say, oh yeah, we're getting agency debt, or we're getting a bridge loan and it's going to be refinanced in 24 months. But they're not telling you what, is that a loan a recourse loan? Because you as an LP investor, if it's a recourse loan, unless it's properly structured, you can be potentially on the hook for that loan because it's a recourse loan and you're technically an owner of this LLC, even though you're a limited partner. So, very few investors, as far as LPs, I think, don't really focus enough on that lending component. So, for example, a really simple one I saw a couple of weeks ago in a pitch deck, their projected hold time was 5 to 7 years. But when I asked them about their lending kind of afterwards, they had a 10-year hard prepay. So potentially they were looking at paying $2.5 million as a prepayment penalty. And when I say they, I really mean me, because I'm lower, in that capital stack than the debtor. So if they have to pay the loan people $2.5 million extra to get out of this deal because of the type of financing that they chose at the very beginning of the deal, that's $2.5 million not being distributed to the LPs when the property sells. And I don't think enough LPs pay attention to that lending component. And that's just one example of what we kind of dive into. In May, we have someone that's going to be coming and talking about the insurance aspect of it, because, for example, if the property catches fire and there's, 40% of your units are down because of flood, water damage, fire damage, smoke damage, that could take months to go ahead and get all those units back up and running. Does the operator have the proper insurance to cover that? Do they have any sort of business loss income insurance component to it? So there's a lot more than, I think it's a lot more than what the pitch deck presents. The pitch deck is just, in my opinion, kind of the tip of the iceberg as far as looking at the property. But, there's only so much time and only so much bandwidth people can absorb information in a 30 or 45-minute pitch deck. So that's why we really want to offer that additional kind of level of education for LP investors to stop and take a beat and really think about all the implications of the decisions that weren't necessarily discussed in a pitch deck.
That's super valuable. I mean, Cody, we've been talking about this a lot. I feel like it keeps coming up. The importance of getting the right debt on property. They look at it's 80% loan to cost, it's bridge debt. Sounds great. You got this 2.9% interest rate, but nobody stops and thinks about, well, when it comes due and after the IO period, can we even refinance in this market cycle?
Yep.
What's the other exit strategies with this debt? We're seeing this now in the market now where a lot of people got the wrong type of financing the last 2 or 3 years, and they're selling these assets with a loan assumption because it's their only choice, right?
Yep.
So I think it's a huge value you're providing to your community, sharing that information, that alternate angle that people definitely need to be considerate of.
Absolutely. I mean, the lending is huge. I mean, just the kind of something I'm personally concerned about in this particular market, with cap rates having kind of gone from, maybe 6 to 4 in some markets pretty quickly. If that loan to value is, 70%, 75%, that sounds great. But what happens if the cap rates start going back up, on the off chance, even if at the same NOI, you have that same NOI income, but the cap rates start going back up, that's going to reduce the value of the property. And then the lender's no longer at 70 or 75% LTV. Well, the lender's, kind of the top priority here. They're going to make sure they stay within their bank underwriting standards, so they could potentially do a capital call and say, hey, we know you're not in default. We know the asset's running, but we need to stay within our valuation. So they could potentially do a capital call if cap rates start rising. And obviously, with interest rates and cap rates having some level of correlation, so if one goes up, the other is going to go up. They have a direct correlation. We are at historically low interest rates right now. We really can't go much lower. So our only direction is up. In my mind, that means cap rates only can go up. So unless you are really, really pushing that NOI to kind of compensate for that increased cap rates, for the increase in interest rates that I know are coming. That's a potential problem I see with some future deals coming down the road, is that valuation is going to start getting kind of skewed, and then it's going to be capital call time.
Yeah, man, that's such a big nugget for people to understand. Again, I really, really appreciate this conversation, because it is such an important component of the business. And as you alluded to, listen, our debt, our lenders, they're our number one capital partners in these deals, and so you have to be aligned. You have to have the right strategy. And I have this interest. I want to do a whole separate show and a whole separate discussion on kind of market forecasts and kind of talking about what you mentioned about interest rates, cap rates, and things like that. Because it's funny, you talk to 100 different people and you're going to get 100 different forecasts and 100 different responses. But the overall point I allude to is that just goes back to the importance of getting educated and getting in the circle with people like yourself who are providing this good concrete value add education, because you can get steered a lot of different directions, and so you really have to align with whoever it is that you feel resonates with you, that's giving you that education, and take your time. I think that's the big thing right now, is we're seeing a lot of eagerness, a lot of impatience, a lot of deal fever. And look, we got to talk ourselves off that cliff sometimes too, because we're like, we just, we're ready for the next one. But you got to, you just should be patient right now and understand that it's a weird time in this market cycle.
Mm-hmm.
We're seeing a lot of things that can expose you to a lot of risk if you're not careful. So.
Yeah, I agree. And I see that from an LP perspective. I know the whole door count thing is a very kind of flashy tagline a lot of, GP teams like to use. We closed on 500 doors last year, and that's great. But from an LP perspective, of those 500 doors, how are they performing is what I care about. If you had 50 doors and you knocked it out of the park and everything's great, to me, that's a more valuable investor than somebody who's closed on 500 doors and, they haven't paid distributions to their LPs in 9 months. So I know a lot of LP investors, they kind of hear the mantra, oh, you want someone who's been through the 2008 cycle. You want someone who's done a downturn, has gone the entire full cycle on a property. And while those can be great, and yes, experience teaches you a lot, I want to know how the deals that you currently have are functioning. And are you putting out distributions? Because from an LP perspective, that's why I'm investing with you. I'm a passive investor. That's what I want. I either want a really high equity multiple or I want really high distributions. I'm happen to be the latter as opposed to the former. But I mean, it's knowing that as an LP investor that, experience is one thing, but execution is something else entirely.
Yeah. And that's something that we've been hearing more and more in the space right now from passive investors is, again, they don't really care about the unit count. They don't really, what they want to know is what was the historical performance or on the distributions that you paid on your other assets. And that's a huge point. Sponsors need to pay attention to that for sure.
Absolutely.
So let's pivot, Alex. I want to talk about this Reg A fund, and I'm gonna pick on you a little bit because I hear Reg A and I automatically think Grant Cardone and whatnot. So are you the Mrs. Grant Cardone, or what's up?
No. So basically the Reg A fund actually culminated from, experience we had in the syndication world. So obviously in 506B and 506C, you are limited with the number, 506B especially, you're limited with a number of non-accredited investors that you can work with. Obviously with 506C, it's only accredited investors. Well, in our military community, accredited investors are kind of far and few between. It's just, we know what everybody's income level is. Military spouse underemployment and unemployment has always historically been a problem, even before COVID. Just COVID made it worse. So, you're oftentimes talking to households that are very often a single income household, or maybe, 1.5 income household, depending on if their military spouse is able to kind of progress in any sort of career. And they weren't being offered an opportunity to invest in real estate the same way civilian, 2 income households with 2 adults that can kind of progress their careers, have that disposable income. And, a $25,000, even a $25,000 minimum can be a big ask for a military family, much less the more traditional $50,000 minimum buy-in for a lot of these syndication deals. And nothing against the operators, it's purely numbers. It's regulations they are trying to stick into. It's not like they are trying to purposely exclude everybody who can't afford to put in $50,000. But obviously working in this community, everybody we knew had some affiliation with the military. And it was like, oh yeah, this sounds like a great deal. I'd love to get involved in real estate. I'd love to be a passive investor and kind of knock down some of that income I have coming in from my W-2 job with the military. But I don't have $50,000 to invest. And even if I did, it's a little risky to put all $50,000 of your investment into one asset, one operator, one market. So we started as kind of a team, just kind of evaluating, how can we really reach the military community and help them invest in real estate? Because as I told you at the very beginning, if I moved 19 times in 20 years, that really starts to eliminate options for me as investing in real estate, because my lifestyle is going to dictate my ability to invest in real estate. So that kind of, through that research, Regulation A fund turned out to be what we felt was the best option. So for example, to invest in the fund, the minimum is $5,000 as opposed to the $50,000 in a syndication. And in the fund, you can invest multiple times. So you could actually invest up to once a quarter, which is different from syndication, because syndication, it's, you're investing in this one deal, it closes and then you're done and you're on. So there's no opportunity to kind of roll that capital into something that could be potentially income producing in that smaller kind of increment amounts, ongoing throughout the year. So if they got a signing bonus, at one point, and then maybe they got another distribution from their signing bonus, later on in the year, they have somewhere to put that capital, that's still going to earn a decent return. It's still going to be secured against property, and again, it's in that multifamily space. So going back to that economy of scale, for security is wonderful.
Again, I want to just highlight and appreciate the fact that you're providing that service and value to military families and members. I think that's phenomenal. So, thank you for that. But, there's kind of a stigma when it comes to some of these Reg A funds. And as you mentioned, you're looking at investors that are contributing a $5,000 minimum versus a $50,000. There seems to be a perception of, well, are those going to be really sophisticated investors, or do you want to be taking investment capital from somebody who can't contribute 50,000? Because typically that would indicate that they may not be in a financial position where they can recover from a loss, or they can recover from, maybe a 5-year hold or whatever the case may be. What's your remarks on kind of that stigma?
I would say it's not so much, it's a matter of the investor's goals and meeting them where they are, and treating each investor as an adult. So just because someone, doesn't have $100,000 to go ahead and invest specifically right now, does that make them any less educated or intelligent or capable of investing? For example, if I had just met an operator and I really like them, I might watch 2 or 3 deals kind of from, beginning to pitch deck to closing, and, get in on their newsletter. And then, maybe a year from now, invest $50,000 from them. But, right off the bat, am I going to do that right off the bat? No. So it could be just maybe an entry point for someone that says, you know what, I want to try out this real estate investing. I might have $100,000 of stocks. Maybe I'm going to pull out a little bit out of the stock market. That seems a little bubbly these days. And then put it into another asset class. So really it's just offering them an opportunity, as opposed to, hey, it's just another way for us to take money from people that don't have it. There are kind of limitations as to what someone can invest in a Regulation A fund, as opposed, like their ratio of their income or disposable income to what they can invest, their annual income. So there's still those limitations, those kind of guide rails. So someone is not putting, their entire $100,000 that they have available for, family emergencies and everything. There are regulations in place to kind of protect an investor from that perspective. So there are some upper limits for investing.
Yeah. Okay, good. Yeah. I think it's important just to know that real estate, is a lot of this is about timing. And, to your point, listen, there's a lot of people out there that are looking for opportunities to invest, but like you said, hey, I don't have the 50K, but I can swing this if it was an opportunity. So I appreciate you highlighting that. And I think it's important for people to be a little bit more open-minded, because we do. And this is a conversation that Brian and I have all the time when it comes to, looking at 506B and 506C offerings. We've seen a lot of operators kind of struggle with the 506C offering, because you're trying to appeal to accredited investors. But what happens is you discover that, okay, that pool of resources, excuse me, may be limited, or, you're competing against other investors that are looking for that same capital. And you have plenty of people that are sophisticated investors that would love to invest in a deal, that would be great partners, but they just don't meet that accredited investor threshold. So, point being is, it's definitely good to be open-minded and not label people just because of that guideline. I want to talk to you about as a fund manager real quick, and then we'll kind of wrap up after this. But, what we know as Reg A funds to set up, they're quite expensive. Talk to us a little bit about kind of creating the fund and some of that initial startup, if you will, because this is something I'm interested in.
Yeah, absolutely. So it really was a process of getting obviously an SEC attorney involved, starting the discussion on, how do we want to have the organization set up very similar to a syndication, having that kind of umbrella corporation, and then there's a management arm, and then there's another arm that's going to be in charge of doing distributions and holdings and all those. And that was obviously kind of spearheaded with the attorney's guidance, getting those operating agreements up and running for those various legal entities. From that point, it's putting together the documentation, the 1A filing to get approved by the SEC. Again, with a lot of guidance from the attorney. You have to have the financials for the actual entity itself audited. So we had to get an auditor involved. The auditor has to go through the books. Obviously, if you're a brand new entity, it's a little bit easier versus if you're somebody that's already been up and running for a little bit. But the auditor has to be involved and say, yeah, we've inspected the books. They put their statement in. You have an accounting firm that's also weighing in and keeping track of the books and what's being spent and accounting for all the expenses, because there are a lot of expenses, like you mentioned, up front before you can even collect a single dollar from a potential investor. So all of that has to be accounted for, again, with the accounting firm, the auditing, that has to go into a 1A filing for what the expenses are, who the managers are, what the structure, is it a corporation? What state is that corporation in? All of those things kind of have to come together and be approved by the SEC. And I think people kind of go, oh, your fund is waiting on approval from the SEC. There must be a problem. Every fund has to be approved by the SEC, so, but at the same token, just having SEC approval, I want to let passive investors know that that's not like the green light, everything is good, this is kosher. That just means that that particular fund, that particular financial offering, according to the documents that were submitted, are okay and pass or above bar with the SEC guidance for whatever the type of fund, whether it's, CF fund, regulation 506, whatever you're doing. So just because it has that SEC stamp of approval, I don't want passive investors to automatically assume, oh, the SEC approved it, these guys must be great. That's not the kind of, that's not the kind of background, that's not the kind of approval process the SEC is going through.
Yeah, that's a very good point. How long is it taking you to get the fund from concept to approval?
I would say the initial kind of inkling for the concept probably started about a year ago, honestly.
Okay.
And then submitting paperwork and getting everything to the SEC probably took 3 months worth of kind of effort. And again, this is also kind of COVID timing. So if you're looking for normal, I don't know what normal is because we did this during COVID. So everybody's working from home, everybody's trying to get things done, and that tends to slow things down. But then once everything's kind of submitted to the SEC comes back with kind of their comments, and questions. We need you to tweak this. We need some clarification about that. You send the comments back. That whole process can be anywhere from, my guess is about, I think on the shorter side, the attorney has mentioned about 45 days to potentially a couple months, just Gotcha. Depending on, what the requirements are for the SEC to go ahead and approve your 1A filing. Mm-hmm. And then after that, you have to go and talk to the various states. Each state potentially has you need to file for, blue sky regulations, blue sky laws, and be able to sell securities in their state. You need to let the state know that, hey, we're going to be in the area, we're selling X amount of securities in your particular state. And there's also kind of filing fees associated in quite a few states with letting the state know that, hey, we're going to be selling securities to your state residents. So all of that, again, is handled traditionally through the attorney, but that's still more fees on top of the SEC attorney. And then you obviously have a pretty good marketing team put together, because Regulation A funds tend to have some of the highest capital limits that you can raise. So for example, we're shooting to raise $50 million in 12 months. So with that kind of big audacious goal, you need to have a big audacious marketing plan to go along with it, which tends to have a big audacious bill. So having that in place is also key. So I would say the major expenses are getting the attorney, process set up, get it going. The marketing obviously is going to be quite expensive. The blue sky filing fees are going to be quite expensive. So all of that leads to basically it's a 6-figure process just to get it off the ground. So it's not something where an operator can just go, I really like this 506B thing. Let's go ahead and make a Reg A fund out of it. And then 2 weeks later, they're going to have a fund. It's really a very time intensive and capital intensive process.
Yeah, absolutely. It's probably why we don't see a whole lot of them. And typically when you do, again, jokingly, you hear the Grant Cardones or whatever, they have that marketing power, that marketing budget that they can allocate to that. And like you mentioned, the setup fees and stuff. So, but yeah, it's definitely something, just another tool in the tool belt to understand and know that's available to you. And, and it sounds like there's a lot less limitations on what you can do with the Reg A fund as opposed to our 506B and C offerings that we're typically dealing with. So it's interesting. I appreciate you alluding to that. So all right, Alex. So let's see. You're a chemistry professor. You're a Reg A fund manager. You're an education leader. In your Facebook group. I mean, what else can you possibly add on your plate? What's in the forecast for you going in through 2021?
Oh, I am having so much fun. We just closed on our first short-term rental. Probably going to have that up and running within the next 6 weeks. So it's our nice little escape that hopefully other people will enjoy escaping to as well here with COVID. I see just like massive growth, honestly, personally and professionally. Like I'm genuinely just very excited. I know 2020, kind of has, all the memes are circulating around the internet, 2020 and a dumpster fire and all this. And I feel bad. I'm sitting here. I'm like, 2020 was awesome. Yes, it's terrible. 500,000 people have died of this disease. It's terrible. Businesses have been put out of business due to government regulation saying you can't be open. There are terrible things happening. My own job got moved home and now I'm home 24/7, which has its own set of setbacks. But I mean, I had a great time in 2020. I prospered financially, personally, professionally. It was just one of those things the world changed and I was like, okay, I didn't have an hour commute to work each day, for example. So what did I do with that extra 2 hours of my day? I went looking for a community, couldn't find it, decided to start building a page or a group. And then the group took off. So I'm like, all right, I had no marketing background, no, digital, anything graphic, I never took a single art class in all my years in college. And I was just like, okay, we'll just figure it out. We'll give it a try. We'll see how it goes. And I was only able to do that because the world changed, because I had that 2 extra hours a day. I was not driving back and forth to work. So I think it's just a matter of, it's not so much fighting what's coming because it's always going to change. 2021 is going to have its own set of challenges. 2022 is going to have its own set of challenges. It's a matter of, can you change with it and just accepting that it's going to change. There's no reason to trying to keep fighting it, resisting it, wishing it would go back to the way it was before 2020, the whole, whatever that looks like for you in your head. It's just a matter of, okay, here's what it is. What can I do to make the most of whatever that change is?
Yeah. That's such an important takeaway. It's all about perspective, right? I mean, and we talk all the time about mindset or whatever. It's all how you interpret your surrounding and your environment. And you can pave your own way. You got to make it what it is. And, you just got to go with it, roll with the punches. And, I love that. I appreciate that. So Brian, you got anything else for Alex?
No, just, you're awesome, Alex. That's all I got to say.
Thank you, Brian.
And boom. No. Well, Alex, man, this has been a great conversation. Really, really appreciate learning more about you and your background and all the nuggets that you've shared with us here today. But before we wrap up, we have a few more questions and then we'll kind of end the show from there. And, the first thing that we like to ask everybody at this point in the show is, what are you doing for your own continued education to further your investing?
Absolutely. It's talking to people. I actually set a goal back at the beginning of COVID when the world shut down, is I wanted to talk to 5 new people a week, which turned out to be, 1 new person Monday through Friday, which at first was a little difficult. And now that the group is as big as it is, and, that's far easier. But it's literally just talking to new people, getting their experiences. we're all on this blue spinning marble together, but we all have a very unique story. It might feel like we're very alone, especially, here in the COVID age. But just talking to other people and hearing their story, hear what they're struggling with, hear what their personal experiences have been, has been amazing. So I would definitely say further education can be through other people. I know a lot of people love podcasts. I personally love podcasts. I listen to probably 10 to 12 different podcasts routinely every week while I'm on my treadmill. I really enjoy it. But, I think there's something to be said for having that one-on-one, 2-on-1, 3-on-1 interaction with other people that I think accelerates your learning. So for me, personal development really begins with talking to other people, seeing what I can do to help them. Later on down the road, they come back and say, hey, you mentioned you had this need, I just met someone that, does exactly what this need is. I'd love to connect you to. That happens to me all the time now because I've been doing that talk to 5 new people a week thing for almost a year.
Mm-hmm. Mm-hmm. And with everything being relationship business, you never know who you meet in talking with those people. Not only are you gaining from their wisdom and knowledge, but I mean, look, that's how we got connected through a mutual friend, and it just snowballs from there. So really cool. What have been some of the lasting lessons you've learned along your journey?
To make sure that you set yourself up for your own lifestyle design. I feel like most people, they don't really, they think of quote unquote retirement, or they think of what financial independence is going to be. They're going to kick back in their hammock drinking tea in the sun, but they don't really think about all the other components that might be required. So I often talk to active investors. They're like, oh, my goal is to get 20 doors and then I can retire. And I'm like, I don't think 20 doors is going to be nearly as passive as you think it's going to be. Unless you got great cell phone reception in that hut in Tahiti, you're going to be involved in some stuff, so really being very diligent about what you want your lifestyle to look like. Like my personal mantra is I invest passively so I can live actively. So if I get an opportunity that comes my way that is more time consuming or geographically constraining than I'm willing to put up with, I know that's automatically shuts that out of my screening process. And I'm like, no, this is not an opportunity or a deal or whatever the situation is that I want to be involved in, because it doesn't meet those 2 very high level metrics for myself, because I'm very committed to the type of lifestyle that I want to live. So intentional lifestyle design.
Love that. Love that. I love the way that you have that stated too. That's really powerful. What would be some advice you'd give to the listeners to help them grow their business?
I would absolutely positively focus in, again, kind of going back with the private lending, on what you want to do and who you want to help. Those 2 questions, if you can dial in really well to what you want to do and who you want to help, I think that's going to really dictate where you're going to push your business, maybe even starting a new business, because it's got to be something that's focused. It can't be, I'm just going to, for example, I'm going to go start a real estate podcast. Well, that's great. But there's like 90 different ways to invest in real estate that I could list off the top of my head. And all those people are going to be very different audiences, and some will be overlapping, but, those are going to be a very different audience. So it sounds almost counterintuitive, but if you want to attract more people to you, you really have to narrow down that funnel and who you want to talk to. I mean, if America alone has, 330 million people in it, you can dial down pretty much as far as you want to. And chances are you're still going to have a few million people that would be interested in your message, your business.
Mm-hmm. Yeah, very good. Great advice, Alex. Really appreciate that. Tell the listeners how they can learn more about you and get connected with you.
Absolutely. They can, I'm in the group Private Lending Lessons, obviously every day posting, answering questions, also very active in the group. I'm also on LinkedIn, and my little code, you can put it in the show notes, is I am investing passively to live actively. So that's my little URL. I thought that was cute when they told me I could personalize it. I'm like, I know exactly what I'm going to make it say. Everybody does their name. I'm doing this. So I'm on LinkedIn routinely. So anybody could message me on LinkedIn. They can find me on Facebook through the group Private Lending Lessons. My website is infiniteroadinvestments.com. And I have something on there that, they can do, give us their email address. We will email them a kind of little starter pack on what private lending looks like from a perspective of, if you wanted to start private lending, here's what the overall process is. Here's some considerations to have, here's how to sort of get started. And so it's a 30-page kind of almost little graphic ebook that will break it down for people there, so they can go to the website as well.
Very cool. We'll make sure that is in the show notes, and definitely encourage everybody to visit that and take advantage of that. Alex, great conversation again. Really appreciate your time, and thank you for tuning in with us today.
Thank you very much for having me. I had a great time.
Thank you.
Thanks, Alex.